Hello to the students, welcome. This is an asynchronous pre-recorded video on the 5 financial ratios we covered in class. And now we're looking at additional reference points, and we're going to use the Lululemon. I'm uploading this to YouTube because my cloud storage is maxed out. If anyone from the general public is viewing, welcome. My name is Franco. I also go by Frank Sakuchi. I'm an associate professor at MacEwan University. This content is for a class at the University of Alberta Faculty of Extension in their financial management and budgeting class, which I am grateful for them that I can use my material for that class. That being said, what's the goal of this recorded video? We're going to look at 5 financial ratios. By no means are these financial ratios exhaustive in determining the financial wellness of an entity, but it's a starting point. It's an introduction. We have to take it bite sizes. The first ratio I'm going to look at is the current ratio. It deals with liquidity. The current ratio has you take your current assets and divide it by your current liabilities. And here we're just going to look at, again, the current liabilities right in here and your current assets right in here. If we took Lululemon's current assets as of January the 30th, 2022, it would be $2.6 billion, where I'm hovering my mouse right in here. Those $2.6 billion at that point in time, divided by $1.4 billion of current liabilities at that point in time, we would get on our calculators 1.85 and change. What does that mean? That means we have $1.85 in current assets for every $1 in current liabilities. The higher your current ratio, the more liquid you are. The more liquid you are, the greater likelihood and probability that you can survive the short term. A number in isolation, and this applies to all the ratios we're going to look at, has little value as opposed to a number in comparison. What would you compare it to? Compare it to your peers? What's the current ratio of the other companies that Lululemon competes with? Compare it to trend. What was your current ratio in the past? Is this a favorable trend or an unfavorable trend? Compare it to budget. Where did you want to be and where did you end up being? How does that fare? So comparison points. Those are 3. There are many, but you have at least some. Again, the current ratio is your current assets, where I'm hovering my mouse here, divided by your current liabilities. The higher, the more liquid you are. The more liquid you are, the more likely you can survive the short term, which is 1 year or less in the accounting terminology. Okay, so we've got current ratio, liquidity ratio. Now we're going to take a look at another ratio, the working capital, which has us take those very same 2 variables and now not divide them, but subtract them. Well, why would I subtract them? I already have a liquidity ratio, you might be thinking. Well, let's say somebody had, let's say this was $2,614 in current assets. That's what they had in current assets. So let's say it's a teenager, a young teenager has $2,614 in cash or things that will turn into cash in a 1-year period. This young teenager also owes, let's say I'm just gonna, the highlighted part, let's say owes $1,405 to his or her parents. And the deal is he has to pay that within the next year. And let's say it's for a new bike that he purchased, a high-end bike. And parents said, you have many bikes, but if you want another one, we'll lend you the money, but you have to pay us back. Well, $2,614 divided by $1,405 still gives you 1.85. 2.6 billion divided by 1.4 billion still gives you 1.85. Theoretically, that teenager would have the same current ratio as Lululemon, because 2 billion divided by 1 billion is the same value as $2 divided by $1 as a ratio, which is a relationship of one number to the other. Well, what the heck does that 1.85 even mean that we just calculated? It means we have $1.85 in current assets for every $1 in current liabilities. So how do you quantify that? Well, we introduced the working capital. So the working capital ratio, or formula, I should say, was also found on page 5, just below the current ratio, and it has you subtract the two. So working capital has you take your current assets and subtract it from your current liabilities. And when we take 2.6 billion, subtract by 1.4 billion, we get 1.2 billion. And that's the amount of working capital you have. The larger it is, the more liquid you are. The more liquid you are, the higher probability you have of surviving the short term. And so those are two basic liquidity ratios. The higher they are, the more liquid the company is. So let's build on it. So here, not to make this too long-winded for you, let's take a look at profitability ratios. So for the profitability ratio, we're going to go to the income statement to start. And here, we're going to take the net income and we're going to divide it by the revenue. So here, this is $975 million divided by $6.2 billion. When you take 975 million and change, divide by 6.2 billion and change, you will get a ratio, just a little calculation here, about 15.53%. So some number is going to show up on your calculator or on your phone, your calculator function of your phone. You're going to multiply that by 100 and you'll get 15.53%. Well, what does that tell me? That tells you for every dollar Lululemon has right at that coming in, they keep a little under 16 pennies for themselves. But then you might ask, well, what's this over here? What's this comprehensive income? Well, that's everything that Lululemon has done. And so, they have some foreign exchange currency. They're in different countries. And at any one time, you may lose or you may gain on that. But to keep it simple, because we're in bite size, I'm just going to stay with the net income today. Before we open too many cans here and just get overwhelmed. And so here we're going to stay with net income. The higher your net profit margin, we just calculated the net profit margin by taking our net income and dividing it by our revenue. The higher the net profit margin, the more profitable you are. The more profitable you are, the more favorable it is for you. Your profitability shows, a well-run organization. What level of profitability is acceptable? You may ask. What percentage is acceptable? Again, it's a number in isolation. How do you compare to your peers? How do you compare to trend? How do you compare to budget? This is $6.2 billion of revenue, which they retain 15 to 16 pennies. That margin is greater than Costco. Costco has more sales though, but smaller margin. They're on different models. So Costco is about volume. Costco has over $100 billion, well over $100 billion in revenue, but a much smaller margin, but more dollars coming in. It's their business model. Lululemon has their business model. So again, these are not peers. Lululemon is not a peer with Costco. So it's important to have peer evaluation. The higher the net profit margin, the more profitable you are. The more profitable you are, the more favorable it is for your assessment of how well your organization is run. But compare it to peers, compare it to trend, compare it to budget. Those are not the only comparisons, but those are the three we're going to work with. They're part of the top comparison points. Well, that's profitability. What else can I do for profitability? Well, we can do a return on equity. what's a return on equity? We can take that very net income of 975 and we can divide it by the shareholders' equity of this company. How much shareholders' money is in here? Well, right here, $2.7 billion. So the shareholders have $2.7 billion into this company, and the creditors have $2.2 billion. So we compare that 975 million from the income statement and divide it by the equity here. So 975 million, I've got some calculations already predetermined over here to my right, divided by 2.7 billion. That's going to give us a series of numbers on our calculator on your phone, multiplied by 100, and the value you achieve is a percentage. So here, the return on equity is 35.6%. So for every dollar that the shareholder has invested in Lululemon, there is a return on that dollar of 35 pennies. But that does not go to the shareholder. That's just the company they own for the dollars they put in. The board of directors and will determine how much dividends go to the shareholders. But if you were the owner of the company, that for every dollar you put in, you generated 35 pennies. How much comes out, how much do you take out as the owner will be dependent on the board's decision on what the dividends will be. The higher the return on equity, the more profitable you are. The more profitable you are, the more favorable it is for your assessment to gauge how well the company has been running. So that's the fourth ratio. We did two liquidities, current and working capital. We did two profitability ratios, which were net profit margin and return on equity. Now we're going to do the fifth ratio, debt to assets. So again, on your test 2, you will have these two financial statements, the balance sheet and the income statement. It'll be all available to you. You have to calculate these 5 ratios. In calculating the debt to equity, we go back, we do it all on the balance sheet. We have total debt of $2.2 billion of debt. Well, how does that compare to total assets? Because it's the debt to asset ratio. Well, to total assets here is 4.9 billion. Well, I take 2.2 billion and I divide it by 4.9 billion. And on my calculator, I'll get a series of digits and I multiply by 100 and I'll get 44.5 or 0.57, 0.56%, which basically tells me that for every dollar that Lululemon has, about 45 cents of that dollar came from debt. If 45 cents came from debt, then 55 cents must be from equity because they have to equal to 100%. So 45% came from debt. The higher the debt ratio, and there's a number of debt ratios. This is one, debt to assets. The higher the debt ratio, the greater indebtedness you have, the greater leverage you have, the less solvency you have. Is that a good thing or a bad thing? The board of directors will decide on their target of their debt to asset. They may or may not always reach it, depending how operations are going. But the board of directors decides on that profit point. I remember having a conversation with one of my adult sons about a company that had no debt and how well they must be doing. That's not always the consensus. A company can do well with debt for its shareholders because if it can have a return on investment that's greater than the debt cost, they are giving shareholder value. It's not, they're borrowing $1 from the bank. They put the dollar to use. They employ the dollar. And that dollar generates more return than the cost of debt. This is favorable for the shareholder. Of course, that sword cuts both ways. Now, if you borrow the dollar, you employ the dollar, and your return on the dollar is less than the cost of debt, Well, now it's going to be harmful to your organization and to your cash flow. So companies have their debt target, and some of those companies keep it close to their chest. Some companies are open and transparent about it. The board of directors are willing to determine their threshold, just like you're comfortable with a certain amount of debt. And out of all the viewers, some don't like more than this ratio. Some are very comfortable with this ratio because they're borrowing money for investment purposes or for real estate or for whatever other initiative they have. But the more debt you have in relationship to the assets, the less solvent you are, the more leveraged you are, the more vulnerable you are, because as interest rates go up, there's more commitment of payments that you have. And so then you decide on the strength of the organization. So here we looked at our 5 ratios. I've already broken my golden rule that I don't have to talk too much in one recording. And so again, with this mirror, I feel like an accounting finance angel to you. So hopefully I passed on a little bit of wisdom, and we'll shut it down now. Thank you very much. Talk to you next time.